Okay, welcome back everybody. Today is going to be our first day of actual class. We went over the introduction to the course. I posted that on the 14th. Let's see here, we're on top of our Moodle shell here for intermediate accounting. So just to remind everyone once again, here is the link to the syllabus right here for the course for fall 2020. Just want to remind everyone to please read it before starting any of the coursework. This video right here, the introduction to the course, as I said, I posted on the 14th. This pretty much just goes over the syllabus and just gives a little bit of details about the course and what's expected of everyone. So just take some time to read through the syllabus and to watch the introduction to the course. Also, I pointed out on the introduction video about this first assignment here, the introduction assignment. And pretty much you just need to get in here before August 22nd of this year. Obviously, you have until 11:59 p.m. to go in and complete this. Pretty much what the project entails is just get in here and just introduce yourself. Pretty much just tell me your name, where you're from, and what some of your hobbies or personal interests are, stuff that you find interesting. You don't need any book or content to be able to attempt that or be able to fulfill that assignment. So please get in there and do that. Once again, as I told you on the introduction lecture, that this is mainly because financial aid and the college is trying to track down students. This is their first checking point to make sure students are doing what they're supposed to do before they disperse financial aid, and also a way of whether the teachers keep someone in the course or not. So just make sure you get in there and do that work. Today we're going to be going over chapter 1, so I'm going to be working directly off the chapter 1 PowerPoints here. This lecture, really, there's not going to be any quantitative stuff that goes along with it. It's pretty much qualitative. We're just pretty much just getting into some of the rules and the standard setting bodies and stuff of that, different types of financial statements. So we're going to get into that now. So let's go ahead and flip over to our slides here, PowerPoint slides. Okay, so this is, once again, it's intermediate accounting. This is chapter 1, the demand for and supply of financial accounting information. So let's look at some of our learning objectives. So we want to understand the forces that drive the demand for financial accounting information in the world economy. So we want to understand the forces that are going to determine the supply of accounting information, including the role of the Securities and Exchange Commission, also known as the SEC. We also need to explain the role of the Financial Accounting Standards Board, also known as FASB, and they're going to be for establishing U.S. generally accepted accounting principles, which are known as U.S. GAAP. Then we want to explain and use the FASB accounting standards codification system and understand the standard setting process. Then we're going to explain the role of the International Accounting Standards Board, also known as the IASB, in establishing international financial reporting standards, which are also known as IFRS, and their efforts to try to converge accounting standards between the FASB and the IASB. We need to understand the output of the financial reporting process and the 4 primary financial statements, as well as the important information reported within those financial statements. We need to understand that because financial accounting information triggers important economic consequences, integrity and the ability to resolve ethical dilemmas and are going to be essential to the accounting profession. So let's get into learning objective number 1 here. So what are some of the forces that actually create the demand for the need for financial accounting information? So pretty much we have companies that are out here on a global scale, and they're all competing for resources. And by resources, I mean financial, the capital, so money, physical and natural resources, intellectual property and technology, new products and service ideas, skilled employees, executives, customers, and suppliers. So really that's going to be the force that creates the demand. So obviously if it's creating the demand, that means in order for these companies to compete for these types of resources and financial capital, then they have to have a means of communicating with the third parties or the parties that would be able to supply this capital, or to the new employees coming in, or trying to attract these executives, whatever it might be. We need a way that we can communicate to them to show both the performance of a company and the strengths and weaknesses of a company, the financial position, and really management's views and opinions on where the company is, both performance-wise and financial position. So these forces are going to create that demand for financial accounting information. So with that demand, with the forces driving that demand, then obviously these companies need to engage in certain strategies that are going to help them fulfill, being able to raise that capital, or being able to hire that right executive that can steer or direct that company in the correct way to be more profitable. It also be key in obtaining suppliers or creditors, lenders, whatever it might be. So the strategies that companies need to develop is a business plan with a broad strategic objective and specific tactics. The business model should guide its strategy and business activities to be different from its rivals and utilizing whatever competitive advantage it might have. So for some firms, they might have a better supplier than other firms. So maybe they have a better price that they're locked into. So therefore, they can provide the same type of a product at a cheaper price. Maybe other firms are better at the timeliness of delivering a product. So that's their competitive advantage. They can get the product to them. It might cost a little bit more, but it'll get to their doorstep at a quicker time. Amazon's a good example. They have a lot of competitive strategies at Amazon. First of all, they have pretty cheap products on there, but mainly the Amazon Prime is really, in my opinion, what really just separated Amazon from the other their competitors like Walmart or other online businesses that they're competing with. Their strategy was, you pay a little premium up front at the beginning of the year, and they guarantee delivery of their goods or services within two days. Not a bad little business model. And as we can see, Jeff Bezos has been extremely successful and is an endeavor with Amazon and with his other investments that he's made. So great business plan. So that's how we can see, that's a prime example how we can see a good strategy, how it can really lead to pulling in those valuable customers and those valuable employees, and be able to obtain capital and be able to expand and grow your business as you see it. Next, let's get into some business activities. So these are going to be the activities that a business actually undertakes. We'll start with the financing activities. Pretty much financing activities is going to be the means in which a company raises its money. So how are they going to obtain capital to be able to fund their operations? So financing activities can consist of issuing stocks. By stocks, we can issue either common stock or preferred stock. But another issue is bonds. So bonds is the debt. So obviously we're gonna sell bonds or issue bonds in which we're gonna receive capital, and we're gonna have to pay them back both interest and principal. So that's the debt instrument. Sorry, the bonds is debt, and your stock is going to be your equity instruments. And another thing, we can even just go to a bank and just try to get a loan. So all these are different types of financing activities. Pretty much long and short, how is the company raising its capital or its money in order to be able to fund or finance its operations? Okay, then we have another type of activity is going to be investing activities. So investing activities is where a firm actually acquires productive resources. What I mean by productive resources is it's going to be items such as property, plant, and equipment, right? So what do we mean by property, plant, and equipment? We can mean either a tract of land, so that we're going to put a building on. Maybe it's a tract of land with natural resources, so it's got gas or oil, whatever it might be, whatever the natural resource is. Equipment, maybe we have equipment. Maybe we're a manufacturing company, so we're going to invest in, and we'd have to buy land. So there's a property. The plant, we have to build an actual facility to be able to house the equipment, right? And then that equipment, we're going to manufacture, let's say, tennis shoes. So we're going to use that equipment to manufacture tennis shoes. We can also invest in technology, intellectual property, legal rights, and operating agreements necessary to operate the business. So pretty much investing activities is going to be something the company's going to invest in, whether it's tangible, meaning property, plant, or equipment, or technology, or if it's something that's intangible, like the intellectual property or legal rights. So your intangibles. So pretty much that's what investing activities is. Operating activities. Pretty much operating activities is the day-to-day activities to produce goods and services and sell them to customers. So operating activities, stuff of that would be like salaries and what else would be another one? Interest expense, stuff of that sort. Stuff that's going to be required in order for the day-to-day operations to be able to see this company's operations and see them through. So those are the three types of business activities. Very important: financing activities, investing activities, and operating activities. So next we want to talk about stakeholders. Who are the stakeholders in a company? So pretty much a stakeholder is anyone with an actual interest in a company. And what do I mean by an interest? So they have an actual financial interest, right? So they've either bought a bond that was issued from a company, meaning that they are a creditor to them because they have given the firm money, and in turn they want to make money off it, right? So they're going to receive interest payments along with their principal payment back at the end of the life of the bond. Other ones, like I said, they could buy common stock, so that would give them an actual voting interest, an actual ownership interest in a company. So they've actually bought into the ownership of the company, the equity of the company. With in turns, they want to receive maybe dividends. Maybe that's what they're looking at the return is, to receive dividends or to grow with the company. Maybe to let the stock become more valuable. So let's just take a look at some of the stakeholders here. That's what they're listed here. Common equity shareholders, we mentioned that. So that's going to be your common stock, your preferred stock, just buying directly into a company's stock. Banks are going to be stakeholders because a lot of times banks are going to actually fund the operations. Creditors, once again, we said the creditors, these are people going to be buying bonds, stuff of that sort. Managers and employees, they're going to be a stakeholder because obviously managers and employees work there, so that's their livelihood. That's how they receive their paycheck. Suppliers, they're going to have a stake in it because they're supplying their goods. So obviously that has a direct correlation on the success of their business, meaning, the more they sell, the more successful they are. The less they sell, the less successful they are. That's why they're in business, is to make money by supplying goods or services to another company. Labor unions and pension funds, those are going to have a direct tie-in to the stakeholders. As a stakeholder, customers have a stake in the company because that's where they actually buy their goods or services from. Governmental authorities, they're the ones that are coming in and setting regulations to make sure or to ensure that the firms are not operating in an illegal way that's going to be harmful to individuals or to an environment, or to a collective group of people. And then we have the local communities. These are also stakeholders because usually local communities are going to benefit directly off a company if it's within their community. Obviously, this being so because it's going to bring more jobs if a company comes in. If a company leaves, then obviously the community is going to feel it because a lot of jobs are going to be taken with that company closing its doors and leaving. So that's pretty much what a stakeholder is. So pretty much stakeholders are very important because without the stakeholders, there wouldn't even be a business. So that's why it's important to be able to relay this information. That's another reason why there's such demand for financial information, because everyone's concerned with the business in some manner or another, in some capacity. So with the importance of stakeholders, obviously they need to know information. So what exactly do stakeholders need to know? So let's start with investors. Investors, the business model, strategies, and competitive advantages of the company, right? So they're going to know what these competitive advantages are, because usually investors, when they're investing in something, they want the company to grow, right? So they're going to be concerned with what your competitive advantage is. If you don't have one, then how are you going to outperform your competitors? Your strategies, your business model, all this is relevant here. They're concerned with the resources that the company owns and the debt it owns, because obviously if it's got a heavy debt structure, then it's going to owe a lot more than the actual resources that it actually has. the net income or net loss, cash flows, and whether profits and cash flows are growing over time. Investors are concerned with this because obviously, I think anyone can put two and two together and know, you don't want to invest in something that's dying or shrinking, right? You don't want to invest your money into something and the only way to get your money back out is a return of capital, like a liquidating dividend. You're going to want to see it grow, because if you invest your money into something that grows, then your money's going to grow, so your interest will grow with it. So that's why they're of concern with the income or loss and the cash flows. Next, creditors, they're going to be concerned with the amount of equity capital in place, resources the company owns and the debt it owes, cash flows, and the company's ability to meet interest and principal payments when due. Obviously, look at this last one here. The cash flows the company's ability to meet interest and principal payments when due. Obviously, creditors, if they're going to buy into it, meaning they're going to loan you the money because they believe in your business model, then obviously nothing is for free. When you obtain a loan, there's always going to be an interest and a time element that's going to be attached to the principal, right? So if I'm going to loan money, if I'm going to buy a bond from a company, I don't want them just to give me back what I gave them, because in essence I'd be losing money. There's no value in that, because really they've held on to my money and not given me anything in return, i.e. interest, right? So they want to be able to ensure that this company can meet the interest and principal payments when due, because that's the whole point in even giving the capital to the companies, because you want a return for your investment. And obviously the resources the company owns and the debt it owns has a direct relation or direct correlation to the cash flows and the company's ability to meet those obligations of both interest and principal payments. So next, let's talk about what drives stakeholders' demand for accounting information. So stakeholders need financial information to make informed resource allocation decisions, right? The financial reporting process must communicate financial accounting information to existing and potential investors, creditors, lenders, and other external decision makers. Information must be relevant and faithfully represented. So in these two last things, relevance and faithful representation, are two of the key ingredients of the framework here. Information has to be relevant, meaning it has to do with, you don't want to present information that has nothing to do with the topic at hand. If we're talking about basketball, we're not going to explain the rules of a football game, right? Same with soccer. We're not going to be concerned with the rules of volleyball and soccer. So the information has to be relevant here, right? It has to be relevant to what's going on. And it has to be faithfully represented, right? So meaning if a company says that they have an inventory of $1 million, then that needs to be faithful. There actually has to be inventory that is valued at $1 million by whatever the framework states on whatever the cost flow assumption is that they're using on valuing and reporting their inventory. So it has to be faithfully represented, right? So let's talk about the separation of ownership and control. So obviously there's a separation of ownership and control, and this is specifically dealing with like the corporate structure, like corporate America, these big firms, right? Because that's pretty much what intermediate's getting into, is these big boy firms learning how they operate both in the U.S. and internationally. So that's what we're talking about pretty much. Then the structure of a corporation is set up to where there is a separation of ownership and control. What do I mean by that? So the investors and creditors are going to be known as principals. The principals are the ones who provide the financial capital and who own the resources, right? Then on the other hand, we have executives, managers, and employees, which are known as agents, the agents to the principals, right? And they have the day-to-day control of those resources, right? So with there being a separation of ownership and control between the principals and the agents, then obviously this is going to create some type of information asymmetry problems, right? What do I mean by information asymmetry? Pretty much it's just a breakdown in communication of information, right? So pretty much the principals are going to just have to pretty much take the word for whatever the agents are providing to them, because they're controlling the operations, whereas the principals own it. So pretty much this is why we get into the corporate structure of corporate governments here. That's why there's board of directors, because the board of directors are supposed to look after the both they have a fiduciary responsibility to the principals, right? And that's why they want to make sure that they hire the correct agents, i.e. the executives, managers, employees, to fulfill whatever the principal's desires are for that company, right? So remember, there's a separation of ownership and control, and pretty much there's some information asymmetry problems here. So this is pretty much just a chart just showing what we just talked about. So you can see here at the top, the separation of ownership and control. So once again, that's between the principals, which is people who own it, the ones who contributed the capital, and then the agents, which once again, these are the managers and executives, employees, and so on and so forth. Once again, the separation of these two, the separation of them, and is going to create the information asymmetry, all right? And that's going to be between the common equity shareholders, the creditors, other resource providers, and once again, that of the executives, managers, and employees, right? So that's pretty much long and short. This is just a visual. Sometimes it helps to just see something. The other was the actual wording. This is the visual of it. And long story short, the only thing I'm really concerned about here is just know that there's a separation of ownership and control between the principals and agents, and it creates information asymmetry. So what drives the demand for accounting standards and independent audits? So a natural demand arises for accounting standards that managers can use to measure and report financial statements that are relevant and representationally faithful. So in order to be able to ensure that the financial statements are going to be relevant and representationally faithful, there's some sets of professional standards in which accountants must follow. We'll start off by just mentioning what these standards are. I'm sure everyone's probably heard of them by now. We'll start off with generally accepted accounting principles. This is going to be known as US GAAP. So moving forward in this class, most likely I'm going to just refer to it as US GAAP. And then the other is the International Financial Reporting Standards, also known as IFRS. Now, they are not sufficient to meet the user's demands. This is merely just a framework, right? So accounting standards require many choices, judgments, and estimates. This gives rise to demand for independent audits. So obviously, if we're just following a framework here and then we're given the freedom to use choices, judgments, and estimates based upon our professional ability and our professional knowledge, then we have to have a demand for independent audits, right? So external auditors must be independent experts in the accounting who carefully evaluate a company's accounting records and verify whether the financial statements are fairly presented in accordance with professional standards. So pretty much external auditors, they really know the accounting system, the frameworks, and they also have a system of their own, the theory of audit, which they use to actually audit the financial statements to ensure that they are what they say they are, pretty much long and short. So now that's the end of learning objective number 1. Now let's touch on learning objective number 2. So this is the supply of financial accounting information. So pretty much the supply of financial accounting information is going to be determined primarily by the interactions between two main forces. So we have authoritative professional accounting standards such as the US GAAP and IFRS, which we just went over. US GAAP is for US companies, IFRS is those for international companies. And those standards govern the company's country of incorporation. So whichever country your company is incorporated in, it's going to be governed based on if you're in U.S. it's going to be governed by U.S. GAAP. If you're in a foreign country, it's going to be under IFRS, another GAAP. So choices, methods, and estimates and judgments that the company must make in order to apply those accounting standards to measure and report their financial statements. So once again, remember there's choices, methods, estimates, and judgments that the company can make, right? So there is some leadway with professional judgment that the standards allow. Let's talk about the SEC, also known as the Securities and Exchange Commission. I'm sure everyone's heard of the SEC. They were created by the U.S. Congress, the Securities and Exchange Commission. And particularly, they were originally created to administer the Securities Act of 1933 and the Securities Exchange Act of 1934. Pretty much the mission of the U.S. Securities and Exchange Commission is to protect investors, maintain fair and orderly markets, and to facilitate capital formation. So pretty much they want to make sure that people, everyday people like me and you, or these big boy investors, whatever scale of investing we're on, they want to protect the public interest pretty much. Let's think back to Enron. Enron was just completely cooking the books. They had a bunch of shell companies to keep the debt off the books, to make the company's financial position and financial performance look much, much stronger than what it really was. So pretty much it was a bunch of speculative crap. There was nothing even there. So they were lying to the general public, and a lot of people lost everything based because of Enron and WorldCon and all this stuff. And we're going to get into this stuff later, but pretty much that's the mission of the U.S. Securities and Exchange Commission, is to keep stuff like Enron and WorldCom from happening, because eventually those firms completely failed and people lost everything over it. So that's pretty much the mission of the U.S. Securities and Exchange Commission. They want to make sure it's fair and orderly markets, and that companies are operating within the framework and the regulations in which they should be. Under the acts, the SEC has the legal authority to prescribe accounting principles and reporting practices for all corporations issuing publicly traded securities within the U.S. capital markets. So keep in mind here, the SEC only has authority over those of publicly traded companies, right? So Securities and Exchange Commissions make sense because if you're public, then you're publicly trading securities on an open exchange, right? So what are the SEC's reporting requirements? So the Securities Act of 1933 is going to require companies offering securities for sale to the public in the primary and secondary markets to file a registration statement. The registration statement is known as Form S-1, and this is very important. It's an imperative law because prior to 1933, you could offer a securities offering and to somebody, and you don't have the registration statement. So you could collect their money, give them a little piece of paper saying they have the security, and then turn right back around and travel to the next town, do the exact same thing, and just continue on and so forth. So there was no registration statement filed with any type of exchange. So pretty much people thought they owned something that they really didn't. They were just being taken. So that's why it's so important that you have to have a registration statement to show that anything being offered for sale to the public in a primary or secondary market is filed with a registration statement to ensure that only one of those securities could be sold, right? Next, the Securities and Exchange Act of 1934 established extensive reporting requirements for listed companies. So once again, these are publicly listed companies on an open exchange, right? First, the Form 10-K. This is just an annual report including the financial statements, right? So the annual report is going to be the most comprehensive, most time-consuming report that's going to be filed with the Securities and Exchange Commission, required by all companies, the annual 10-K, Form 10-K. This can be found on the SEC's main site. You can go there and find any publicly traded company and go in and look at their Form 10-Ks. They're very long and exhaustive reports, but it breaks down everything on it, and we'll talk about that later in the course. Form 10-Q is just an interim quarterly report, which includes the financial statements. This is not going to be as in depth. It tends to use more estimates and judgment than that is appropriate for the year-end annual report that falls under the Form 10-K. Form 20-F is an annual report for non-U.S. companies, so anyone operating or incorporated outside of the U.S. boundaries or territory is going to be required to file a Form 20-F, so it's going to be like Form 10-K for U.S. companies. Form 20-F is for that of international companies. Form 8-K is a report used to describe significant events that may affect the company. What do I mean by significant events? Maybe they had a major issuance of new stock, right? Or another issuance of bonds. Maybe they changed an accounting principle and how they value inventories or something. So all this stuff is going to be relevant. Maybe they switched to the fair value of reporting for their securities that they're holding. So any of these things would be relevant and significant events, right? So that's going to be accomplished through the Form 8-K. Proxy statements pretty much is just management requests the right to vote through proxies at shareholder meetings. So that's pretty much all a proxy statement is a report used when management requests the vote through the proxies at shareholder meetings. So these are the different types of the SEC's reporting requirements. So now some more on the SEC's authority over accounting standards and financial reporting. So the SEC frequently enforces its regulations on companies, exchanges, and investors. So that, once again, remember, they have all authority over these public companies, and every now and then they will enforce it and penalize companies, or even make them hold their trading on an exchange until whatever it has to be is taken care of. If it said maybe they have a bad audit opinion, right? They have a modified audit report. Then they could stop a company from trading. And once again, remember this, because their main focus is to maintain orderly and effective capital markets, right, and efficient markets. They don't want people to get ripped off and screwed over by investing into a company that's cooking the books pretty much. So they're going to enforce these regulations on companies. The SEC is going to delegate its authority to establish accounting standards to both the FASB and the IASB. So although they have the authority to establish these, they just go ahead and just delegate that authority to the FASB and the IASB. So with that being said, the FASB and the IASB is going to be the ones that promulgates GAAP, right? And promulgates meaning just create, develop, and bring forth into the codification. So the SEC exercises its most direct impact on accounting standards through its input and informal approval or rejection of standards that have been proposed but not yet issued. So instead of deciding what constitutes generally accepted accounting principles through EDIC, the SEC has endorsed the concept of substantial authoritative support. So pretty much, instead of being like a dictator on this, like saying this is what the rules are, you have to follow them, we don't care what your opinion is, we don't care that you're the ones practicing and using these standards on a day-to-day basis, this is what it is. Instead, they're saying, we're going to have substantial authoritative support. So, they actually care what people's opinions are to a certain extent. So let's talk a little bit about the FASB. This is learning objective number 3. Let's look at the timelines here. And this is I just want to go over the timelines because it's good to know where you came from in order to see how you ended up where we are today. So I'm not going to really test you on these individual timelines of the different authoritative bodies and how they became ultimately the FASB, but we'll just go over them here for a second just so we have an idea. The Committee on Accounting Procedure, known as the CAP, it was formed by the AICPA, which is known as the American Institute of Certified Public Accountants, back in 1938. The CAP issued accounting research bulletins known as ARBs. Next, the Accounting Principles Board. This was formed in 1959 by the AICPA, and it was intended to replace the CAP. They issued Accounting Principle Board Opinions, known as APBs. Next, in 1973, to replace the APB, the FASB was formed, known as the Financial Accounting Standards Board. So this is the one that is relevant to today, that's still known as the FASB. Something to keep in mind here, both the ARBs and the APB opinions remain sources of GAAP. That is, unless they have been superseded or amended by the FASB, because there is times where old literature can be superseded or amended through accounting standard updates known as ASUs. We'll get into that a little later in this lecture. So pretty much, long story short, that's the history of how we got to the FASB and the different standard setting authoritative bodies, and how we evolved into where we are today. So pretty much the main thing is, for me, that I want you all to know, just know about the FASB, because that's where we are. Chances of you seeing anything on this, you might get tested on the CPA exam if you all choose to sit on the CPA exam. So I'm not going to bog us down with information that I do not feel is imperative. So let's learn a little bit about the structure of the FASB. Once again, I'm not really concerned of everyone memorizing, knowing how many members and the voting process and all that stuff. I just want you to get an overview on how the FASB structure really is. So first of all, there's seven members of the FASB. They're all full-time employees with no other organizational ties, right? Members represent a wide cross-section of interests, so they can be auditors, users, academics, financial statement preparers. And each board member is required to have a knowledge of experience in accounting, finance, business, and accounting education and research. They need to be disciplined. They need to have a lot of integrity and obviously be very intelligent. A concern for the public interest regarding investing, financial accounting, and reporting. So pretty much, each board member is required to have this type of personality or these type of morals driving them, and qualifications for obviously the discipline and intelligence and everything. So once again, let's just talk about the structure of the FASB. This is just a visual of what we just talked about. So pretty much we have the Financial Accounting Foundation, known as the FAF. Pretty much all I want you to know, there's the Financial Accounting Foundation. You can see there's 14 to 18 members here. So the FAF appoints and oversees the Financial Accounting Standards Boards, which is the FASB, which we talked about, and the Financial Accounting Standards Advisory Council, and the Private Company Council, right? So the Financial Accounting Standards Advisory Council and the Private Company Council are going to advise the FASB, and then they're going to appoint the task force known as the Emerging Issues Task Force. They consult the Financial Accounting Standards Boards on trying to support or push through these new ASUs. We also have the administrative staff and the research and technical staff, which are consulted by the task force, including the Emerging Issues Task Force, which in turn support the FASB as well. So pretty much the FAF right here, they appoint and oversee the FASB, the Private Company Council, and the FASAC, the FASAC, pretty much the Financial Accounting Standards Advisory Council. And then pretty much from there, the FASB appoints the task force, the Emerging Issues Task Force. I'm not gonna really be concerned really on how, like I said before, how many members are included in them. How there's 33 in the FASAC, and then the Private Company Council has 10. I'm not concerned with that. Mainly, I just want you to know there's the Financial Accounting Foundation that appoints and oversees these two bodies, which then creates and has the Emerging Issues Task Force. So let's talk a little bit about the Emerging Issues Task Force. So the FASB established the EITF, which is the Emerging Issues Task Force, in 1984. This was due to a response to the need for timely guidance on new specific accounting issues. Pretty much, the EITF is pretty much was created, so it was pretty much a helping branch of the FASB. It helps. It gives them another department to be able to focus on more of the day-to-day, more of the easier topics, and getting them resolved at a more timely pace, so they can leave the FASB and the more of the upper level bodies to focus on more pressing and more difficult issues. So pretty much they help out to ensure that stuff's getting produced in a timely manner. Once again, that the objectives of the EITF. Identify significant emerging accounting issues that it feels the FASB should address. So, like pretty much, they're just, like I said, they're dealing as a third party here that they feel they should address. Develop consensus positions on the implementation issues involving the application of standards. These consensus positions may be viewed as the best available guidance on GAAP, particularly as they relate to new accounting issues. So once again, pretty much the Emerging Issues Task Force is just dealing with these day-to-day issues, keeping the FASB and the FAF and these other bodies from being bogged down with it, to where they can focus on more pressing issues and more difficult issues. FASB pronouncements. Prior to 2009, the FASB issued several types of pronouncements, which had different levels of authority. Although the FASB no longer issues these type of pronouncements, they are still cited in accounting literature, and many companies still refer to them to explain how they apply to GAAP. So these managers and accountants can still use these pronouncements to show how they actually came about coming up with GAAP, or how it was applied. Because this collection of pronouncements were lengthy, sometimes hard to use, and conflicting, and even really inconsistent, the FASB conducted a major project that resulted in the FASB's accounting standards codification. So pretty much what the codification is just it's a real-time, active, one-stop shop for all FASB's authoritative literature. All their standards codification is included in the FASB's accounting standards codification. If there's old literature in there that's been superseded, you'll see it's been superseded. It's in real time. It's up to date. So pretty much this took out the inconsistency and the conflicting stances on it, to where accountants can now come to this one-stop shop, pretty much, which is known as the FASB Accounting Standards Codification, and get answers and guidance on applying GAAP. So it's actually really pretty neat. Historical types of FASB pronouncements. I'm going to go through these a little bit here as they are relevant and when applying GAAP. If you do not have one of the highest authoritative things to reference. Statements of financial accounting standards. Once again, these pronouncements carry the highest authority within GAAP, establishing the methods and procedures required on specific accounting issues. Interpretations. These pronouncements refine GAAP by clarifying conflicting or unclear issues relating to previously issued standards. Staff positions has issued pronouncements to provide more timely and consistent application guidance and to make narrow and limited revisions of standards. Technical bulletins. FASB staff issue these pronouncements to clarify, explain, or elaborate on accounting and reporting problems related to specific standards. And the statements of financial accounting concepts. These pronouncements establish a theoretical foundation for financial accounting and reporting standards. They're the output of the FASB's Conceptual Framework Project, and they're fundamental principles that guide the development of GAAP. Then we have other pronouncements on a major topic. The FASB staff also may issue a guide for implementation in the form of questions and answers. So pretty much that's just the historical types of FASB pronouncements, not to bore you just reading verbatim, just wanted to get through them there. So now let's talk a little more about the FASB Accounting Standards Codification. And once again, this is learning objective number 4. So the FASB Accounting Standards Codification, like I said before, it's just an electronic database that integrates and topically organizes the U.S. GAAP into one coherent body of literature. It became effective July 1st, 2009, and it was pretty much developed to achieve 3 goals. They want to simplify user access by organizing and categorizing all authoritative U.S. GAAP into one database. They want to ensure that the codified content is accurately represented in all U.S. GAAP. And they want to create a codification research system that is up to date, including the most recently released standards. It's important to note that the FASB's ASC, also known as the Accounting Standards Codification, is now the only source of authoritative GAAP for U.S. companies. And obviously they're going to use it to determine how to record their transactions, events, or circumstances, and how to report the results of their financial statements. The codification does not change GAAP. So pretty much just know the FASB's ASC, Accounting Standards Codification, is a one-stop electronic database, one-stop shop for all U.S. GAAP. Let's talk about the Accounting Standards Codification Framework. Let's talk a little bit about it. So pretty much it contains 6 components or levels, which are increasingly more specific. So obviously we have the very most broad topic, which is the areas. It links to 9 broad general accounting subjects. What we mean by general accounting subjects, we mean like assets, liabilities, equities, expenses, revenues, industry, like broad industry topics, stuff of that sort. Topics. We can touch on numerous topics based upon those areas. Then they involve guidance on particular subject areas. So maybe on assets, maybe we're particularly concerned with current assets, in particular maybe cash, right? So that could be a section of a subtopic. The cash would be. It would characterize the nature of the content in a subtopic. Subsections refine and break down sections into a narrower and more specific item. Paragraphs contain the specific guidance that constitutes GAAP. So pretty much you start out with an area and then you get deeper into the topics, the subtopics, the sections, subsections, until you all the way get down to the paragraphs. So pretty much you start with a broad category and then you narrow it down. You keep narrowing it down into a funnel until you find the precise topic or the precise guidance based upon that broad scope or that area or that topic, right? So that's where you'll get down into the subsections and paragraphs. An example would be the FASB ASC reference number. You can see here at the bottom, for example, it says 330-10-31. So 330 will be the topic. So for example, 330 could be like, I want to say it's assets is 300 in the codification, just off the top of my head. But pretty much that'll be your topic will be 330, the subtopic will be the 10, the section will be 30, and the paragraph will be 1. So that's pretty much just the layout of how the standards codification framework, how it actually works. So the FASB's process and operating procedures. A newly released standard by FASB is referred to an accounting standards update, also known as the ASU. So I'm going to just read through this here a little bit so we can see that the process in which the ASU is brought forth. Before issuing a new standard, the FASB completes a multi-stage process. On major issues, a task force may be appointed to advise and consult with the FASB's research and technical staff. Once a preliminary views document or invitation to comment is published, the FASB holds public hearings similar to those conducted by Congress. After deliberating on the views expressed and information is collected, the FASB issues an exposure draft of the proposed update. After a 30 to 90 day waiting period for additional comments, the FASB will draft the proposed standard for a final vote. And then the accounting standards updates require a supermajority, at least 5 votes. Because remember, there's seven people, so supermajority, at least 5 of the votes. The standard will include a basis for conclusions, which explains the rationale for the new standard or an explanation of board member dissension. So pretty much it's an open viewing, open process here to the public. They have a waiting period for comments and everything. So let's just get a visual here. So the FASB's process and operating procedures. So pretty much the FASB's operating procedures can typically look like this. First, the FASB will identify a topic. From that point, they're going to appoint a task force to deal with that topic. That task force will conduct research and then issue a preliminary review or invitation to comment. From that point, they'll hold the public hearings. They'll then deliberate on those findings from the hearings. And then from that point, they'll issue the exposure draft. Then once again, we're going to go back to holding public hearings. Then from that point, if needed be, we'll modify the exposure draft and then vote supermajority. If the supermajority votes, then from that point, we're going to issue the ASU or the accounting standards update. So pretty much that's how it goes through. Just know they issue preliminary views or invitation to comment. They issue an exposure draft. So it pretty much goes through the public process before an ASU is actually put into law. Sorry about that. So the IASB and IFRS, remember the International Accounting Standards Board is what I'm talking about with the IASB, and the International Financial Reporting Standards is the IFRS, just to remind everyone on that. We're now on learning objective number 5. So the IASB is the International Accounting Standards Setter, establishing IFRSs, which are required or permitted in roughly about 130 countries. So as you can see here, a lot of countries adhere to IFRS. IASB, or the IFRS Foundation, is the parent organization to IASB. It consists of a group of trustees that is responsible for fundraising, appointing IASB members, and overseeing the effectiveness of the IASB. The IASB includes 16 members from various countries. And the IASB and IFRS, they pretty much follow a similar process as FASB. The IASB studies the topic, issues the discussion papers, issues an exposure draft, and then evaluates comments and drafts the proposed standard. So pretty much same open process for promulgating these standards. Then if approved by 10 of the 16 members, the proposed standard becomes an international financial reporting standard. So pretty much same thing. They issue these exposure drafts, evaluate the comments, and go so on and so forth. So the public is involved on this, which is nice. So let's talk a little bit about the convergence of FASB and IASB accounting standards. So international convergence of accounting standards refers to both a goal and the path chosen to reach it. So pretty much the ultimate goal of convergence is a single set of high quality international accounting standards that the companies worldwide use for both domestic and cross-border financial reporting. The path toward that goal is the collaborative efforts of the FASB and the IASB to improve the US GAAP and IFRS and eliminate or minimize the differences between them. In particular, the areas, the major projects that are on the table to work on converging is the consolidated financial statements, fair value measurements, financial statement presentation, and revenue recognition. The SEC and international convergence. So obviously we know the SEC has authority to promulgate GAAP or to establish GAAP, but they have passed the buck on to the FASB. So obviously they're going to have a say so in this convergence. Ultimately, they're the ones that maintain the orderly financial markets and the financial reporting of companies. So what the SEC did to help out with this international convergence, and in 2007, the SEC decided to allow foreign companies to use IFRS rather than US GAAP. And they decided that these companies do not need to reconcile how differences between IFRS and GAAP affect the financial reporting process or the statements. So with that being said, professional accountants must be fluent in both US GAAP and IFRS. This does put a little more stress on the accountant, where they have to be fluent in both US GAAP and IFRS, which really they should be anyways, because really, even though the SEC used to, prior to 2007, made them change or convert the statements from that of IFRS to US GAAP and then reconcile the differences on how you got from one standard to the other. Really, it's a lot better this way, because it saves these companies a lot of time, and it really makes it the New York Stock Exchange and these exchanges in America. Our domestic exchanges, really it makes it more attractive for these international companies, because now these international companies don't have to change their whole accounting process and procedures in order to be able to be traded on this company. So now it allows for more equity to come into our markets, more capitals, which is a good thing, because we want the convergence between these international companies and domestic companies. So let's talk about how standard setting is achieved in a political environment. So remember, we said that the FASB and IASB, they develop it on the open standard setting process, meaning they open it to the public for comments and stuff. So it's not really dictating what it's going to be behind closed doors. So the FASB and IASB develop new accounting standards in a thorough, thoughtful, and efficient manner with due process and in open public forums. Because of the substantial economic consequences, key constituents often disagree about the objectives for new standards. So obviously compromise is inevitable with the FASB and IASB, because they respond to the globalization of capital markets. So once again, by the means of the ASUs being brought to law or being brought into the codification, by being open to the public, obviously, by being open to the public for comments and then modifying the drafts before it becomes an actual ASU or a new accounting standard. Obviously, they're going to respond to the globalization of capital markets. So we care about what the key constituents say, because it could obviously have an ultimate economic hardship effect on certain companies based upon just accounting standards, because it could affect on their revenue recognition or expense recognition, which could ultimately affect the performance, i.e. their net income or loss, which would ultimately affect the equity of a company. So just very important here that the standard setting is in a political environment, and it is some compromise here between that of the FASB and the IASB and the key constituents. So now let's get into learning objective number 6 and talk a little bit about some of the primary financial statements. I think everyone, considering this is an intermediate course, should already be familiar with all these statements, but this should be a good review. This course will, however, get into much more detail into each of these statements on the relevant accounts and different sections and different measurement attributes that we have to use within each of these. So, like I said before, we should be familiar with it, but this is just a good little overview and review of what these financial statements are. So you can see the list here. We have a balance sheet, an income statement, a statement of cash flows, statement of shareholders' equity, and notes and other items that typically accompany these statements. The reason why there's notes and other items that accompany these statements is because most of the time the information within the actual financial statements is qualitative information. It's just numbers, and a lot of times numbers can't explain everything, so you have to have some qualitative information backing it and explaining how we actually got those estimates or numbers. So that's why we have notes and other items that are typically accompanying these statements. So let's start with the first one, the balance sheet. So the balance sheet's main focus is to measure the financial position of a company. So it's also known as the statement of financial position, right? The balance sheet is the cornerstone of financial reporting, and it's going to present a snapshot of the resources of a firm. So the resources of a firm we know are known as assets, right? So assets are going to be the resources of a firm. The claims of the firm are also going to be shown here, which is going to be known as the liabilities and the shareholders' equity. And it's important to know that the balance sheet is a measure as of a specific point in time or a specific date. Usually this date is the last day of the fiscal quarter or the fiscal year. So when you see a balance sheet, it's going to say it'll say balance sheet for company XYZ as of December 31st, 2000X, whatever it might be. So it's at a point in time. The balance sheet reports the following equation, this is the basic accounting equation: assets equals liabilities plus stockholders' equity. All right. Same thing you can infer from this equation here is assets minus liabilities equals net assets, which is this net assets is the same as equity. So assets equals liability plus shareholders' equity. The balance sheet views resources from two different perspectives: specific resources of the firm, which is the assets, right? The cash, the inventory, equipment, stuff of that sort, so both current and non-current assets. Then we have the claims by persons or entities. And the claims comes in the forms of the liabilities and the equity, meaning investors, creditors, lenders, suppliers, employees, and other stakeholders that we spoke of earlier. So pretty much main thing with the balance sheet, remember, it's known as the balance sheet or a statement of financial position. Remember, it is at a point in time, meaning it's only relevant for that point in time. Once another transaction happens, it's totally null and void. It's completely null and void as the accounts will change in it. So pretty much just remember that it holds the accounting equation: assets equals liabilities plus shareholders' equity. Next, let's talk about the income statement. So pretty much the income statement is going to measure and report the performance of a company for a period of time, right? So recall the balance sheet was at a specific point in time, right? Whereas the income statement is for a period of time, right? Which makes sense because the balance sheet is the measure of the financial position, right? So the financial position is the financial position of a company at a point in time. Now remember, the income statement is measuring and reporting the performance of a company. So in order to measure the performance of something, you have to actually break it down into segments, right? Or time periods. Usually 1 year is the time period, right? We break it down in interim reporting as well, quarterlies, right? Quarterly reports. So let's get into the income statement. Remember, measuring and reporting performance. So the income statement measures and reports the financial results of a firm's performance for a period of time, such as a quarter or a year. Remember, we're measuring the performance for a period of time on the income statement. It provides information about profits or losses the company has generated during the period by conducting operating, investing, and financing activities. Recall, we talked about these operating, investing, and financing activities earlier in this lecture. Revenues is going to measure the inflows of assets and the settlements of obligations from selling goods and providing service to customers. So revenues is pretty much what a company is in business for, to produce revenues, right? Their main revenue producing process. So we talked maybe earlier, we talked about maybe we were a manufacturing firm, right? How we're investing in like the investing activities of buying that equipment. Well, a manufacturing firm for shoes, obviously their main revenue producing thing is to be manufacturing shoes and selling them. So that's going to be their revenues. The expenses is going to measure the outflows of assets that a company consumes and the obligations it incurs in the process of operating the business to generate revenues. So the expenses is what the company has to incur in order to produce the revenues. And obviously the goal is to keep the expenses much lower than the revenues. So then we have net income or net loss, which measures the bottom line or profit or loss of a company for the period. Another term for net income is earnings. So net income is going to equal revenues, less expenses, plus gains, less losses. Okay, we already touched on what revenues and expenses were. Remember, these are the main driving forces of a company, what they're in business for, like revenue producing activities, i.e. making shoes. We're gonna produce shoes, manufacture shoes to produce a profit. The expenses are gonna be what the energy it takes to run that machine, right? It's gonna be the cost of paying our employees, paying our utilities, paying our interest, all that in order to be able to produce those revenues, right? So those are gonna be just straight revenues and expenses is just tied directly to the operations. But what about the gains and losses here in order to reach net income? Gains and losses are going to be from stuff like, let's say we disposed of a plant asset and the carrying value of it was higher than what the fair value of it was. So we're going to incur a loss when we dispose on it. We'll get to that later on dispositions with property, plant, and equipment later in the semester. Gains could be if we're holding, if we have available for sale securities or trading securities, for example, or available for sale with the fair value elected. So those gains on those types of securities are going to be realized to the determination of net income. So those are peripheral gains and losses, whereas revenues and expenses is tied to the direct purpose of the actual company. Then we have comprehensive income. Comprehensive income is going to be the change in equity of a company during a specific period from transactions, events, and circumstances relating to non-owner sources. So if we look at an income statement, first we're gonna get down from the revenues, expenses, gains, losses, and then income before taxes. Then we'll have the income tax expense, and that will ultimately lead us at net income or net loss, right? Then from net income or net loss, then we have another statement. We can either build upon the income statement, or in a separate statement is going to be your other comprehensive income, which begins with net income. We'll get into those items later in the semester, but those are going to be stuff like adjustments on pensions, net investments in foreign operations, stuff of that sort. Available for sale securities, gains and losses on those when the fair value option is not elected. So we'll get into those later. But if you can see anything I said, change in pension, stuff like that from period of time, all those have nothing to do with the owners, right? So that's why the comprehensive income, which is net income plus or minus other comprehensive income, gives you comprehensive income. And once again, comprehensive income is the change in equity from transactions and events with those relating to non-owner sources, i.e. pensions, investments, stuff of that sort. Next, let's talk about the statement of cash flows. The statement of cash flows reports for a period of time the net cash flows, inflows minus outflows from operating, investing, and financing activities. So once again, the business activities, as we talked earlier, are broken into operating, investing, and financing activities. We provide useful information about how a firm is generating and using cash. It complements the income statement since it demonstrates how cash flows differ from accrual-based income. Useful to creditors and other stakeholders to help evaluate the company's cash-generating ability. It gives information about the likelihood of future cash flows for future payments of obligations. So pretty much the statement of cash flows is pulling out the cash side of it from the accrual. Because we know everything that we do in accounting for these big firms, we follow GAAP, so it has to follow accrual accounting. So pretty much the statement of cash flows is pulling the cash out of the accrual to see the sources and uses of cash. And once again, recall that it can be reported in either operating, investing, or financing activities. And we'll get into the statement of cash flows in a greater detail later on in the course. Next, we have the statement of shareholders' equity. This provides information about the common shareholders' equity claims on the company and how those claims change during the period. Let's talk about contributed capital. This is going to be capital contributed like in the form of purchasing common stock or preferred stock or additional paid-in capital or other additional paid-in capital. Common stock or preferred stock, obviously, if a company is issuing stock and say the common stock is $1 par, then that's where the common stock will be credited for common. If it's actually selling on an active market for $5, then the additional $4 that was paid over that of the par value of $1 is going to be known as additional paid-in capital. So these are just the different components of contributed capital. And remember, we have the common stock, preferred stock, additional paid-in capital. Then we have earned capital. Earned capital is going to be cumulative net income in excess of dividends declared, which is going to leave us with retained earnings. So retained earnings is going to be a component of stockholders' equity. Remember, retained earnings comes from net income in excess of dividends declared, and that'll leave us retained earnings. Net income is always going to be closed to retained earnings at the end of the operational period from the income statement. Obviously, your net income is at the bottom of your income statement, and it's going to be closed to retained earnings. Which is a component of the stockholders' equity, which is a part of the balance sheet. Shareholders' equity affects from the recognition or valuation of certain assets or liabilities is going to be accounted for in accumulated other comprehensive income, known as AOCI. So once again, that's accumulated other comprehensive income. A good example of that is going to be if we have the available for sale securities and which the fair value option is not elected. If the fair value option was elected, the gains or losses on those from period to time when we market the securities to market is going to be realized in your income statement, which will enter into the determination of net income. But if the fair value option is not elected, which is the case of which it'll enter into the OCI, other comprehensive income, gains and losses will be accounted for in other comprehensive income, and then those gains and losses will be closed to accumulated other comprehensive income, which again is a component of the stockholders' equity. Cumulative amounts of cash distributed to the shareholders to repurchase shares, known as treasury stock. So let's go back to common stock. So if the company issues common stock to people on the open market, and then they decide at a later time, hey, we want to buy back some of that stock. For whatever the reason, maybe they're doing it so they can pay executives. Maybe they're just doing it to prevent a takeover, whatever it might be. But those cumulative amounts of cash distributed to shareholders to repurchase shares are going to be accounted for in treasury stock. One thing I want to make sure everyone understands here, treasury stock is a contra equity account. So it's going to actually reduce stockholders' equity. It's going to be the only debit balance that we have within the stockholders' equity. The others are going to be credit balances. So treasury stock is going to actually be contra equity account, reducing the overall stockholders' equity amount. Let's talk about the notes to the financial statements. Companies must provide notes as additional information with the financial statements. These notes explain how the accounts and amounts have been determined. They provide important details about the accounting principles, methods, and estimates the company has used to measure assets, liabilities, equities, revenues, expenses, gains, and losses, including fair values of investment securities, pension and post-employment liabilities, income taxes, and intangible assets. I know that's a lot there, but that's pretty much what the financial statement notes are going to explain. So pretty much what we mean by measuring assets. Let's say we need to provide one of the the required disclosures within the notes to the financial statements is going to be the inventory method, in which is used a cost flow assumption, i.e., LIFO, FIFO, average, dollar value LIFO, whatever it might be. Because if a company values its assets, meaning its inventory, one of its assets, being inventory on LIFO, then it's gonna be carried on its balance sheet at a completely different cost than that if it was carried on FIFO. And the same thing, one's going to favor the income statement, one's going to favor the balance sheet. So it's going to have different expense recognition on the income statement, and the value of that inventory is going to be carried differently on the balance sheet. So it's imperative that the companies disclose this type of information so that the users or the readers of these informations can validate how they got these numbers, how management is using these numbers. Same things like, let's say, expenses. Let's talk about a big expense for companies related to property, plant, and equipment. Let's talk about depreciation expense. There's different methods of doing depreciation. You have the straight line method. You have the accelerated methods, like the sum of the year's digits, the double declining balance, the stuff like that. So obviously this is all going to be relevant in determining the strengths and weaknesses of a company and how they're valued at a point in time on the balance sheet. So notes are very important. Lastly, the manager's discussion and analysis. This is an extensive narrative discussion and quantitative analysis from the company's managers. Pretty much, the managers are providing insight into the strategies that they're incorporating, their evaluation of their performance, the business risk factors that they're exposed to, and the expectations about the future of the company. So pretty much management discussion and analysis is pretty much exactly what it is, what it says. It's pretty much trying to give you the ability to look through that in the lens of the management as to what their strategies and expectations are and stuff of that sort. So that's what the MD&A. So management discussion analysis is also known as MD&A. Managers and independent auditors attestations. So the Sarbanes-Oxley Act of 2002, also known as SOX, is imposed responsibilities upon management and auditors. So first, starting with management. So the management is going to be responsible for all data in the financial statements, pretty much long and short, and the control system in order to generate the financial statements. The control system is known as Internal Control Over Financial Reporting. ICFR is what the control system is referred to as, and then the financial statements of what is produced based upon that internal control. So management, in particular the CEO, Chief Executive Officer, and the CFO, Chief Financial Officer, have to sign off on these statements. It is punishable up to time in prison. I believe up to 20 years, maybe 30, I think, for the white-collar crimes of lying on these. And so it's very important that you take it seriously if you're ever in that position. Independent auditors are going to be responsible for assessing a company's internal control system. Remember, once again, that's the internal control over financial reporting, which this is referred to as the assurance opinion. And it's designing audit tests and forming an opinion, which is going to be referred to as the audit opinion. And the audit opinion relates to the fairness of the amounts reported within the financial statements. So why is an auditor's opinion an essential element of financial reporting? Well, after the Sarbanes-Oxley Act of 2002, it is imperative because you must have an auditor's opinion in order to be able to even be traded on a public exchange like the New York Stock Exchange or on a foreign exchange, whatever it might be. Management has to sign off, and pretty much this is all brought into effect because of what happened with Enron and WorldCom and all those, where they were cooking the books. But just a quick little insight into it. Speaking directly with Enron, one of their independent auditors was that of I just went blank here. Sorry, it'll come to me. I'm sorry. Arthur Andersen. Sorry, Arthur Andersen was their independent auditor, and they were also performing a lot of assurance and um, financial types of procedures and stuff to this client. Pretty much what they knew, these books were being cooked and were cool with it, and because they were getting kickbacks and stuff. So pretty much that was the end of the Big Five. Now the accounting is firms are known as the Big Four. It used to be the Big Five, but obviously with the Sarbanes-Oxley Act of 2002 and everything that happened with Arthur Andersen and Enron and WorldCom and everything, Arthur Andersen no longer exists, and that's the Big Four. So that's pretty much why an auditor's opinion is an essential element of financial reporting. It pretty much ensures the public that you're not lying to them and that you're not just trying to steal their money and lie and say that there's something in the statements is something that it's not. And pretty much Sarbanes-Oxley Act of 2002, also known as SOX, pretty much enforces this by having your upper level management, the CEO and CFO, sign off on these statements, and then also having independent auditors come in and do an assurance and audit opinion. Ethics and integrity in the accounting profession. This is learning objective number 7. So obviously accountants serve the greater good of society and owe a responsibility of ethics and fairness to all current and potential stakeholders whose interests are sometimes conflicting. Accountants are often going to face ethical dilemmas in which an accountant must make a decision about what is right or ethical in order to choose the correct action in order to take. Professional accounting organizations have established code of ethics for their members. The AICPA, also known once again as the American Institute of Certified Public Accountants, they adopted the Code of Professional Conduct, known as the CPC. It includes 6 principles that express the basic tenets of ethical and professional conduct, and also call for an unswerving commitment to honorable behavior, even at the sacrifice of personal advantage. So obviously here, we don't ever want to look at personal gains here as a means or a reason to veer away from the Code of Professional Conduct. One thing about accountants, especially public accountants, your middle name is public, certified public accountant, okay? So your public interest has to be number one. So like I said before, accounting, it requires a strong degree of ethics and integrity to be able to perform the Code of Professional Conduct up to the standards that's required of accountants. No one likes to be taken advantage of, and really, this financial information, when people are just given money based upon the information presented to them, no one likes being lied to, no one likes being screwed over. So just make sure that you're following the Code of Professional Conduct and you're upholding your ethics and your integrity, even if it means you might take a loss from it, because it's better for the general good of the actual general public. So let's look at some of these principles of the AICPA Code of Professional Conduct. I'm just going to read through them here. I know I'm not trying to bore anybody, but I just want to get through them. The first is responsibilities. In carrying out their responsibilities as professionals, members should exercise sensitive professional and moral judgments in their activities. The public interest. So members should act in a way that will serve the public interest, honor the public trust, and demonstrate commitment to professionalism. Integrity. Maintain a broad and public confidence. Members should perform all professional responsibilities with the highest sense of integrity. Objectivity and independence. So members should be objective and free from conflicts of interest in discharging professional responsibilities. A member in public practice should be independent in fact and appearance when providing auditing and other attestation services. Due care. A member should observe the profession's technical and ethical standards, strive continually to improve competence and the quality of services, and discharge professional responsibility to the best of the member's ability. Scope and nature of services. A member in public practice should observe the principles of the CPC in determining the scope and nature of services to be provided. So pretty much there's the principle of the AICPA Code of Professional Conduct. A lot of this just takes in common sense, treat others as you'd be treated, but there is rules in place. So once again, responsibilities, the public interest, integrity, objectivity, and independence, due care, and scope and nature of services. This wraps up chapter 1. I hope this helps clarify the content from this chapter. I will be posting this right here, right under the Chapter 1 PowerPoint, so that'll be available. The link will be available here in a minute. It does have to be downloaded through YouTube, so if you click on it and it says check back later, just give it some time to finish downloading or buffering, whatever it's doing. So that'll be kind of the routine here. I'll shoot the lecture when we're in class. I know this class we're online, but I'll post the lecture right down here afterwards, right underneath the PowerPoint. And as you can see here, this is the teacher's view, the Chapter 1 homework and Chapter 1 quiz. I'm still working on those. Hopefully they'll be available by later today. They're not due until the 28th. So just be on the lookout for the lecture and the Chapter 1 homework and quiz. And also remember to introduce yourself no later than 8/22/20 by 11:59 p.m. Once again, that's all for this lecture. If you have any questions or concerns with anything or anything that makes sense, feel free to send me an email or give me a call on my office phone, or my office hours are listed in the course syllabus as well. Everyone have a good day, and I will be shooting the lecture for Chapter 2 here in the next week or so everyone be on the lookout for that as well. And everyone have a good day, and we'll talk to you later.